The December inflation report from the US was released today, and it wasn't exactly what investors were hoping for. Markets had positioned for around 150 basis points of rate cuts from the Federal Reserve over the course of 2024 by the end of last year. And we have seen that position pared back ever so slightly at the start of this year. Markets now positioned for somewhere between 125 and 150, so nothing too dramatic. But today's inflation data doesn't really help things. If we look at what the expectations were, you can see here for the headline year-on-year figure, the expectation was for 3.2%, up slightly from 3.1. It was actually 3.4. On a monthly basis, it was 0.3 over 0.2. On a core basis, which is arguably more important, it was 3.9 rather than 3.8, but that is still slightly down on the prior number from November of 4%. And on the monthly basis, it was another 0.3% print. So all in all, a slightly worse report, but really there isn't anything to be overly concerned about here. We're talking about marginal changes here away from the previous numbers and from what the markets were expecting. So it doesn't really change the view of where inflation is heading in the US, where it's going to continue to head, and therefore what impact it will have on the interest rates going into 2024 year end and then into 2025. So I'd say today is no game changer, not the ideal report, not what investors wanted to see, and also maybe not what they've become accustomed to. We've seen a number of reports now where the figures have been better than anticipated. So the fact that we haven't seen that may come as a bit of a disappointment, feeding into the slightly more cautious appetite we've seen at the start of the year. But ultimately, I just simply don't think it actually changes very much. But let's see what that means for the dollar. And the chart we have is the dollar yen pair. And the reason why I've chosen this one is because actually around US economic releases recently, this has probably been the most interesting chart because there has been a lot more movement, because we're talking about two currencies which are potentially going in different directions. And by that, I mean the Federal Reserve is looking to start cutting interest rates and the Bank of Japan potentially start raising interest rates. It's created quite an interesting dynamic for the dollar yen pair. You can see that it came off its highs towards the end of the year from around 152 down to around 140. So a huge move there over the course of a short period of time into end of 2024. And since then, we have seen it be pairing those moves. Now, since then, you can see that we've actually run into a little bit of resistance around the 50 fib. And that was always going to be the key test today during this economic release, was whether could we see a break, and a significant break, of that 50 fib around 146. Of course, a few days ago, it rebounded quite cleanly off there and then saw support around the 200-day simple moving average. Now, since then, we have started to rotate higher, but we haven't seen a significant break yet. We have moved above here briefly after the economic release, but we haven't seen a significant move up above here. So the question for many traders at this point will be, is that break enough to generate further upside momentum, or is this a sign of waning momentum during that what looks like at this stage a potential corrective move? The first thing I'd point out here is on the daily chart, the momentum indicators still look quite healthy. So this recovery, we're seeing higher price action and higher momentum on the MACD and also the stochastic. So there's no signs of flagging momentum on the daily chart. If we take a look at the 4-hour chart as well, you can see maybe we are seeing flatlining momentum, but I wouldn't say we're seeing divergences, perhaps minor divergence on the MACD histogram down here. You can see a slight lower high, but broadly speaking, I don't think we're seeing much of a divergence forming at this point in time on the 4-hour chart. I still think those key fib levels are going to be important for traders. I think if we do see a sustainable break above 146, then I think the 61.8 fib around 147.50 will be a key point of focus for traders. But at this point in time, I'm not seeing significant signs of waning momentum. We haven't seen a break below that rising trend line, which I've highlighted here on the chart. If we do see that, then that would suggest we've seen a shift. A break of that trend line could suggest the recovery or the corrective move that we've seen has run its course, especially if it's combined with a break of that 200-233 period simple moving average. But at this point in time, it's actually to the upside that moving average band has broken. So I still think there's momentum with the rally at this point, and therefore perhaps the corrective move that we've seen in the dollar yen, which appeared to start to run out of steam, has actually got a little bit more ground to run. The key levels for me at this point remain unchanged. 146 in the short term, 147.50 if we do move above there. And if we do move lower from here, a break below 145, 144.70 would signify the potential end of a corrective pattern, because it would see a break of that trend line, a break of the moving averages on the 4-hour chart, and also a break of the most recent low.